Well, our next guest correctly predicted the market run-up in the last 6 months of 2009. And when he was last on with us just a few weeks ago, he said that we are in the first phase of a bull market. What does he think now, with the market as tumultuous as it has been over the past week and a half? Well, we're going to put that question to Don Hayes, Chairman and Chief Investment Strategist at Hayes Advisory Group. Don, thanks so much for coming on with us. Last time you were on, you said this is the beginning of a bull market, but you did think that the market was a bit overbought at those levels. What are you thinking about the volatility now?
Well, that was exactly right. And if you look at the last 2 weeks, we've had an up and down market, but it's essentially gone nowhere. But now you're starting to see a little bit of that rolling over. And you were mentioning before breaking through the 50-day moving average. That's the kind of thing that gets the fear of the wall of worry a little bit better condition. I think we're going to see this, Margaret, maybe until the election, very much like 2004, which was the aftermath of the big run-up after the bear market then.
How much are you watching what's happening on the currency front? Because dollar strength can, be problematic, particularly for commodity trades.
Well, that's exactly right, and the dollar has been roaring, and you're seeing this euro, which has been a failed currency for many, many years. Everyone knew you couldn't put all these countries together with different governments, different policies, that one day it would have a big glitch, and it's having its glitch now. So it's going to be very interesting, but you know where everybody goes. They go back to the U.S. dollar, the reserve currency that everybody's been trying to put down, but it continues to be the currency that people seek.
Well, are you seeing opportunities out of this? I mean, with euro weakness, we're also seeing weakness in the European markets, elsewhere, in Russia and some of the BRICS as well. Are you looking outside the U.S.? Are you sticking with the industrials and the energy names here?
Well, we are looking outside the U.S., but the U.S. market will be the strongest one during this correction we're talking about. Probably a pause that may last as long as until the election, 3, 4, 5 months. I'm not talking about a serious weakness, but I'm talking about a market that moves up and down just about the way it did in the first 8 or 9 months of 2004. But the weakness probably will be contained somewhere within 10% of the market, and I think it'd be better to stay in the U.S. now. Now, as you see this evolve, and that's going to happen, you're going to see many of these countries that have been strong up to now, some of the Latin American countries and some of the Asian countries will come back. Those are the countries who appear to be making the most progress at this point.
Now, when you were on with us last, you said that the dumb money wasn't in the market yet. It was the smart money sort of leading the charge. That is to say, retail investors were still a little bit hesitant about putting money to work. You see headlines like we are right now, uncertainty like this, that's got to cause some concern for the everyday average Joe if he wants to get in the market again. So do we really stop at a 10% correction, or how much participation do you expect to see from the retail investor?
Well, I would say more than that, except the market is very undervalued and earnings are very strong and productivity is very good. So you don't have a lot of risk based on valuation of stocks right now. You do have, as we've mentioned, we think that we've just ended phase 1 of the bull market. This is going to be a consolidation in between phase 1 and phase 2. Typically, the public does not come back in until phase 2, and we think that's been the case here. You've seen very little public participation. They've still been going to bonds, very strongly into bonds, but you're going to see they will start returning, if I'm correct, sometime in the fall of this year, and probably in a big way.
Now, you say you expect us to be sort of bouncing around till the election. So what is it that's going to change for you in November?
Well, I think people are very concerned now about what's going on between the Congress and the president and the gridlock that you have. And we have so many things, important things that need to be settled. And I'm expecting, and I think the polls are showing, that the conservative movement are going to win seats. And I'm expecting after the election that you're going to see much more of a bipartisan effort. And that's what I'm hoping. I guess maybe it's a prayer and a hope, but I still think it happened sometimes in the past when people lost their constituency and they turned to someone that really could pull together to get something done. Now, I think the market itself, with Greece, with all these concerns that you have about other things, you're going to see the economy continue to pick up. And I think you will see even somewhere in the next 2 or 3, 4 months concerns about the Federal Reserve raising interest rates. That happened
Yeah.
in June of 2004 and was a major concern for the market then too.
So we've got to quickly go, but I want to know, what does that mean in terms of your cash holdings and your position with Treasuries?
Well, I think if you're looking at where to invest money, the next phase will be technologies. But I think on the Treasuries themselves, they've been driven down by this flight to safety, and they'll start moving up soon in yield.
All right, we'll keep an eye on that. Thank you so much, Don Hayes.